This is the Friday, July 10th, 2015 version of the Market Plus segment. Joining us now is Dan Hueber. Dan, welcome back.
Thanks very much.
Now, on the program, we were talking about the dollar and where you saw it going in the future. And we do have a question here from Chris in Northwest Minnesota. He's saying, do you foresee a drop in the value of the U.S. dollar so we can increase our export demand?
You know, and I do think the dollar is probably top heavy right now. I think the last rally, the 5% or so that we rallied here in the last few weeks, I think was directly related to the situation, the panic in Greece, running for a flight to quality once again. Beyond that, there is not really much there to really maintain that strength at this point in time. So I would not be at all surprised to see the dollar weaken between now and the fall, maybe into the fourth quarter even. Not a wipeout by any stretch of the imagination, but, possibly moving back toward that 89, 90 cent level compared to 95, I believe, here today. Longer term, though, I think the dollar still reigns. I think the world is going to see us continuing as the leader in the economic front moving forward. And we know China is going to have a long, long road before they work out of their problems over there. So I could see where a year from now we would have the dollar significantly higher than we are today.
Okay.
So, probably at least back to par at some point in time in the next year.
Well, sorry, you mentioned on the program there were two big reports this week, and coming from the OECD and the IMF. And as we look for export demand, was there any good news in there that maybe we could see some increasing export demand?
In fact, in that they were really, particularly the OECD, did point out that they thought the strength in the dollar was going to be a detriment to the growth in the U.S. economy, and probably, of course, a little bit of a benefit to European economies, Far Eastern economies. So it's in both of their attitudes, they were very skeptical about the U.S. kind of maintaining. In fact, they cut back slightly 2 to 3% on the projections for the U.S. for this coming year. So, and granted, they were just looking through the end of the year. Each of them, particularly the IMF, was reiterated, I think for the second time in 2 months, that they would not like to see the Fed raise interest rates this year. So interestingly, and granted, the assumption right now is the Fed will raise maybe 25 basis points here in September. I don't know. I mean, I think there's enough international pressure. There's a question mark particularly with the slowdown in the Chinese economy. Is the world economy so fragile yet that really it can't sustain any kind of a rise here? So
we might need all the liquidity we can get from everywhere.
Absolutely.
Interesting.
Yep.
Okay. Now, you mentioned, we talked a little bit on the program. We talked about the report that came out on Friday, the July World Ag and Supply and Demand estimates. We've got a question here from Phil in Ontario. He's already looking to the future. He's saying the August and October USDA reports will be telling. What potential do November soybeans have, in your opinion? And let's talk yield first. Where do you peg soybean yield?
Of course, the USDA still has the yield up at 46. And beans are such a strange crop. I mean, I guess every farmer in the world knows that. I mean, it really hinges on that August weather. Are we going to make or break the crop at that point? 46, we've always thought was very optimistic. And even if you look back over a 4 or 5 year average, you're probably closer to 44, 44 and a half. So we've been pegging 44 and a half on our yields. And again, which doesn't turn the picture in beans bullish, but it's certainly less negative than it was, particularly 2 to 3 weeks ago. So, that said, this 1050, 1060 range on November beans, if we could get there, we haven't been able to quite get that far. Really a stiff historical level of resistance. So I think that's potentially in the cards, but be above and beyond there, or even if we can get there short term, I think could be, we might need another weather spoof to make that happen. But it's, again, we've told people that, in that 1050, 1060 range, if you feel pretty comfortable with your beans, let's go ahead and price them. We can always come back later with an option contract if we see something change down the road. So,
yeah. And now cash prices have risen right along with the board. Of course, nationwide basis is weakened slightly from 2-3 weeks ago.
Always with a rally, you're going to pull back some, so which is understandable. So, that doesn't mean a person can't take advantage of that too. That's when you go to the board. If the basis is working against you, work that off as a sale on the futures, and then of course come back. Anytime you swing prices back down, we know sales are going to dry up pretty quickly, and take advantage of the basis at that point. So.
All right. Now, the August report, Phil was curious about that one.
Sure.
Given that we're going to make the bean crop in August, corn we make in July, beans beans in August.
Sure.
Are you anticipating any adjustments in that August report to bean yield?
Oh, I would suspect. Again, knowing that the USDA left the July report unchanged, which is by no means a surprise. I mean, that is not a crop tour. Those are more population counts and estimates or opinions. So yes, I mean, we suspect that we're going to see corn and beans both adjusted downward on that report. I think those yields, not that they were by any means matching up to beans were matching up pretty well with last year's yields. The corn, even then, they were 3 to 4 bushel below what we produced for a record crop last year. But both were substantial yields, and I think we've had anything but a perfect growing season or even an average growing season to think that those would be realistic at this point.
Certainly. Now, we do have another question from a Chris in Minnesota, a different Chris in Minnesota.
Okay.
And Chris wants to take us back to cattle. And he's curious, as we look out very long term here, when we're talking futures markets, what price level do you predict the feeder cattle market will be at a year from now? Summer of 2016, what's Dan Hueber's feeder cattle price guess?
Difficult question, but in the best of circumstances, I don't know if I can put an actual price on it. From a cyclical standpoint, and I'm going to go back to the grain markets, from a cyclical standpoint, I think we're going to see higher corn prices in 2016. And if we want to go by the assumption that higher prices in grains is a negative on the feeder cattle, I would say right now we're going to be looking at lower feeder cattle prices out in the next year or so. And it's, right now, so many of the things we seem to be setting the stage, not just domestically but worldwide in the grain markets, fits very well with long-term patterns on what you do 2 years, 3 years out from major highs and lows. And not that I'm necessarily predicting any kind of a crop failure in 2016, but I think, there's just enough things happening around the world right now where I'm fairly comfortable in saying, yes, I think we could see corn well into the $5 plus range next year.
So are you a farmland buyer today?
Yeah, well, I guess it depends on where the farm ground is.
Okay.
There is it depends on where, in our neck of the woods, prices have never really backed away tremendously. Okay. So it's that's a little tough to want to, bite off those kind of prices, but I'm sure there's some places there's some value out there. So,
all right.
Yeah.
Well, Dan, thanks for joining us and thanks for gazing into your crystal ball.
Absolutely, my pleasure.
Appreciate your insight. Thanks to all of you for tuning in to the Market Plus segment. Please continue to do so. Tell your friends about it, and be sure to tweet at us or Facebook us at Market to Market. Thanks for watching, and have a great week.